Hello, thank you. I'm here to discuss the findings of the analysis I made on my company. I'm given a few things that stood out where more attention is needed to be made for successful operations and also keeping the company in the business. So I'm going to begin with a strategic plan. That's when we mission, the vision, the values of the company, having a competitive analysis and also the market trends. So generally, my company deals. It's a pharmaceutical company dealing in supply of chronic drugs, that is hypertension and diabetes. So first of all, the mission, the vision. If I give a brief definition of each attribute here, these define the purpose of providing quality chronic care drugs at affordable prices and accessible all over the country. So that's our mission, our vision, and the values. So the values, there is quality, integrity, there is honesty. Among all the products that we are giving, we are dealing with people who are going to be accessing these drugs for over their lifetime, because these are incurable conditions. So the patients whom they are initiated on our products, they are always going to be on these drugs. So we need to be honest about the quality of the products we are supplying to our clients, the accessibility, and also affordability. These are very important if you are to keep in operation, given the demography of the market. It is very competitive. We need to have values that can make us stand out of the competitions. And also, when you look at the competition itself, we need to be very clear. We need to be alert on the market. That's in terms of the companies, what is importing, how are they marketing, what the new plans they have, what new techniques they have to keep on the market, because the market is very competitive. There are many pharma companies that are coming up to start up operations in the country. There are many products that are being invented when it comes to management of chronic condition. That's what diabetes and hypertension. Recently, there are two companies that have introduced a molecule called dapagliflozin. And dapagliflozin is an SGLT2 that's used in the management of chronic kidney, chronic heart, which is very severe. So there are very many companies that have come. So we need to be aware of what's happening on the market. How are our competitors investing? What products? What's the price of our competitors? Is there another pharmaceutical company? What are they dealing in? So you need to be also aware of the market trends. We need to know about the epidemiology of the conditions we are dealing in. We need to know about the patients turn up in the hospitals. We need to know about the statistics, and also about the number of physicians who are handling these chronic cases, the physicians who are handling, let's say, specialty doctors. We need to know actually the 360 of the market, because we believe in a law that 80% of my business comes from 20%, the 20% being the specialty doctor. Those are the cardiologists we are talking about, those are nephrologists we are talking about, and those physicians who are specialized in handling these conditions. So we need to know about all these things. The market competition, the competitive analysis need to be standing out. You need to have a thorough market survey to know the competition, to know how stiff the market is, let's say in the term of products and the market expansion. I need to know about all these things. And also the working capital. When you look at working capital is given as assets minus liabilities. For any company to stand out, it needs to be having enough capital to operate. Enough capital in a sense that you're able to meet the demands. First of all, when it comes to paying tax, you're paying enough tax. When it comes to employing your clients, salaries, paying wages, paying everything that's needed to be cleared. If a company is swimming in a lot of liabilities, having a lot of debts, it reaches a point when there is a lot of financial stress for a company to meet company operations, whereby the company is no longer running very smoothly because it has a lot of debts to clear. So this strains out the company. In that long run, it may fail to operate. At some point, declaring bankruptcy and what ceases to operate. So to operate, you need to have your working capital. Working capital can be in a term of whether you have cash in hand, cash at bank, receivables, you have assets, long-term assets, short-term assets, those that you can sell and bring you liquid, bring you finances, bring you cash. You can keep on investing in the business such that you keep in operations. So it's very important for every company to keep check of its assets and its liabilities. If you're swimming in liability, you need to improvise in a ways that if you need cutting down the expenses so that you normalize the expenses and the debts. It can do that, but in one way or the other, the company needs to have enough assets, need to have enough working capital, and that can only be achieved if you're having enough assets. Because this means that once you're finding stress in operations, you have assets that you can use to get cash to operate. And we're talking about additional funds. Additional funds is the concept used when a business looks to expand its operations. That is, since business that seeks to increase its sales level require more assets to meet the goal, some provision must be made to accommodate the change in assets. So in this case, as someone who is operating in medical field, let's say operating in Kampala, there's going to be a way that because Kampala, everyone who is thinking to operate Kampala is going to be looking at as a rich area, a rich market for any drugs. When it comes to economy, Kampala is good compared to other places around the country. So when someone thinks about the market, you need to expand the territory to beat the competition in one region. Kampala is saturated with a lot of pharmaceutical companies. So to sustain the demand, you need to expand the business outside, like Mbara, which are also busy places like Asese. So to do so, you're going to requires more capital, requires more team, requires more employees, and when requires more employees comes with the need for more funding. So where are you going to get that? There is additional funds needed. Additional funds can be in terms of bank loans or selling assets. Either way, these are very important, but have to keep in. Regression analysis as a technique is very important in analyzing and also telling the growth of a company. For example, in the data we used here, as a person who's dealing in sales of pharmaceutical products, we try to relate our sales with the investments that we make in our marketing. For the last 5 years, we are seeing here, as our investments have gone on increasing year per year, we have also seen our sales increasing. So this gives us a picture that the more you invest in the market, the more you get sales. If we found that the more we invest, we would revise how we are doing it. But in this case, we get an assumption that we have to invest in order to get sales. So literally we saw a linear correlation between our sales and our investment. The more we invest, literally this graph is trying to show, the more you invest, the more you get sales. So the financial leverage, this can be defined as the use of debt to support a company's operations. Using borrowed money can improve company's equity anomaly. This is true if the returns generated from the borrowed funds exceed the cost of debt. However, excessive leverage can increase financial risk, especially if the company's earnings are sufficient. So to have a positive impact, financial leverage works well if the company generates returns on investment greater than the cost of debt. Leverage increases profitability for equity holders. But there is a saying that the rich uses the poor's money to get more rich. So in this sense, we are trying to analyze that. Yes, it's okay to borrow money, but the money should be able to finance. If it's a loan, to service the loan. We should be able to check we are getting this money. We shouldn't be getting loans, but we are working in deficit, because we are going to be having a loan to pay and we are not getting returns. Otherwise, it's okay to get a loan to service our financial growth and our financial operations. And there are very many methods that we can use when we're trying to tell the growth of our business. In this method, we're talking about the linear regression, straight line, moving average, and the percent sales. All this can be used to tell the sales. I've given a brief preamble of how the sales have been over the last 5 years. From these years, we are seeing our sales increasing each year. So in this state we're assuming that if we continue to grow like this, we predict ourselves in 2025 to grow by 25%. 25% to grow by, actually we are predicting 30%, which is estimated to be around 180 80 million as of 2025. Yes. So all these are very important. One thing that stands out for me in my company, it's important to balance our debts and our assets, because companies work on both ways. All things are important, but everything has to be kept in check. If you have enough data and you know how to do the due diligence on the debts, you know how to service, and you know how to keep the books, yes, debts are not very bad, and you can also get leverage on how to run your operations. But otherwise, if you get more debts than the capital you have, you're going to find yourself making a lot of servicing than you should. Thank you.